Rome was not built in a day. That's why you need a lifelong investment strategy. 2 words for you. Birthday investing. It's something I wish I knew about before I started my portfolio. Just kidding.
It's a light bulb and...
A light bulb! Light bulb! I invented that. Me! I'm Thomas Edison. I invented the light bulb.
I actually created this system because I noticed there were a ton of flaws in the most common pieces of investing advice. And obviously, this video is not investing advice. That's for my lawyer over there. Also, a lot of people have been curious about what's in my portfolio or how I invest, and this is going to be the video that shows exactly that. And I'll give you access to everything I'm invested in, all for the price of $500 on my Patreon. Just kidding. It's going to be available for free. Actually, it's even better than free. In some cases, when you do find out, you'll actually gain money from doing so. But we'll cover all that later in the video when we actually go over the portfolio. A lot of people say, oh, you should do index investing. And there's so many issues with that for me personally. And the system I developed, I ended up beating the most popular indices by quite a bit. So we'll get into that a little bit later. And it has helped me in my adventure through early retirement or financial independence, retire early, the whole FIRE movement. And obviously, that's not the main reason why. It's just something that kind of helped a little bit. The most important things you need to do for financial independence, it's just 3 things. Increase your money as much as possible, save as much as you can, and invest the difference. So we're really only touching on the third part. Honestly, isn't like that big, but a lot of people, they asked me before, like, what was your original timeline to do this? And it was around like 10 years. That's what I planned out. And obviously, I took a lot of like, quote unquote, worst case scenarios, not worst case, but like bad scenarios. And then since good scenarios happened, I reduced it by 1 year here, 1 year there, and then all the way down to around like 5.5 years. So that was pretty good. But essentially, birthday investing starts as soon as you begin your first portfolio, and then it should last all the way through Judgment Day. And the reason why I created this is because, again, lots of issues with the common advice of investing in an index. Everyone's different, and it turns out our risk appetite when we are young is a lot different than our risk appetite when we are older, but index investing does not take that into account. Another thing it doesn't do is it breaks the first rule of business, which is buy low, sell high. When you buy an index, you're literally buying high in like most cases. And lastly, there are some people like me, and perhaps you, because you are watching a finance video after all, that want to do more than just do the average. If we're spending a lot of time in something, we want to get a little more out of it. So what can we do? For some people, you could just say like, oh, let me just blindly invest in this index that someone told me to, and just keep all my money there that I worked so hard for because this person on the internet said so. Some people do that. And yeah, just because that happens doesn't mean like you should or even shouldn't do it. But it turns out most people who say to invest in an index either don't know what they're talking about, or they do know what they're talking about, but they don't do what they say to do. So it's a little bit of a dichotomy there. But let's expand on all the points on why I hate index investing. And I need to do this because the reason why I developed the birthday portfolio or birthday investing is that it tackles all of these problems very elegantly, in my opinion. So to start off, a lot of people like investing in the S&P 500 because they believe in humankind, and they're like, oh, if I invest in a lot of big companies in the world right now, and if humans keep making new technological advances, theoretically, money go up, right? Something along those lines. The issue with that is that the S&P 500, which is the most popular index that people follow, is only for US companies. Okay, that's weird. Doesn't really cover that, right? What you'd want instead is maybe like a total world fund, for example. Next thing you could ask yourself is, oh, maybe I invest in the S&P 500 because I'm making a big bet on America. Are you really though? So yes, it's true. S&P 500 has like all the biggest companies in America, but it actually doesn't because it's only the biggest publicly traded companies. So all the companies that are privately owned, such as Cargill, Koch Industries, those 2 companies in particular have revenues that are bigger than like Pfizer, Disney, and Procter & Gamble, and they are not publicly traded, so you wouldn't be able to invest in them. And they do represent quite a big part of the economy, so are you really betting on that? Second of all, you're only investing in large companies, but a lot of people say the backbone of America is on small businesses, and you're investing in pretty much 0 small businesses when you're doing the S&P 500. That means it just really isn't representative of it at all. So people like to define big companies as companies with more than 500 employees, and that only makes up 0.1% of companies. And that's pretty much nothing, right? But obviously they have a lot more people employed. The biggest employers are obviously big companies. So that means it might not matter that they only make up 0.1% of companies because they employ everyone, right? Wrong again. Apparently, small businesses employ 47.1% of the workforce, almost half. Seriously, go outside right now, touch some grass, as the kids say these days, and look around at all the businesses that exist around you. Maybe you have to drive. I can walk because I'm in a city, but if you're out in the country, you gotta drive, right? A lot of them are not publicly traded, and you can't access those markets at all. And considering all of this, you aren't really making a true bet on America. You would want something like a total market fund instead, but even then, it doesn't really cover everything. But all this is a bunch of nonsense that I'm talking about, because who really cares about betting on the world or betting on America? Because fundamentally, at its very core, what bothers me the most about buying indices are you're literally buying high. So
make no mistake, prices are still too high.
Typically, you want to buy low, sell high. For example, let's say you run a fruit stand. You want to buy a lot of fruit that's really cheap wholesale and then sell it for a little bit higher than you bought it for at the stand at like retail prices. And when you do that, you're essentially buying low, selling high. How does that relate to equities? Well, you generally want to buy a company when it's valued low and then sell it when it's valued higher. That way you make some money in between, hopefully. But when you buy an index, you're literally buying high. And what do I mean by that? Well, when a company gets included into an index, there's automatically an arbitrary price jump because all the portfolio managers who manage all these funds that track these indices buy that company, and therefore that company's price goes a little bit higher. This happens with every company that enters the S&P 500, and they get like a nice little price jump even though nothing about the company actually changed. So literally 1 second before being included, all the employees are the same, all the sales numbers are the same, all the clocks are showing the same thing. But once the second hand moves 1 second forward, all of a sudden their stock price jumps up like 2-3%, which is absolutely ridiculous to me. I've heard that sometimes it even goes up to like 5% of a price difference. And a 5% gain, a lot of people say that the S&P 500 returns are anywhere from like 9 to 11% every single year. And that's like half the gains already. So by buying an index, you automatically buy a little bit higher than you probably should. And obviously, this doesn't mean that the companies in the S&P 500 are like always overpriced. It just happens to be so in a few cases. But if we think of owning a stock as ownership in a company, which, newsflash, it is. Some people don't know that, but apparently you need to say that nowadays. Nothing about your percent ownership change, and nothing about the company that you own actually changed at all, except for its price. All that being said, one of the benefits of buying the S&P 500 is that it's a nicely diversified portfolio because it has a wide range of stocks in a lot of different sectors. And this is all fine and dandy until you realize that you have no idea what companies are actually included in the index. At least most people don't. So let's say you have a $50,000 portfolio, and let's just assume for a second that the S&P 500 is an equally weighted index. It isn't, it's weighted by market cap, but let's just pretend it is equally weighted. That means you put $100 into 500 different companies with your 50K portfolio. And that's a little weird, right? Because we spend $100 on regular stuff all the time. Like maybe someone buys like a jacket or like a pair of shoes for $100, and you spend a lot more time thinking about that purchase than you do on your overall financial portfolio. And when you're dumping 50K into something, and you can't name more than 20 companies in the S&P 500, let alone 50, 100, or even all 500, there's something a little wrong there, right? Because you're just putting money somewhere without actually knowing what it is. So I'd say that those are the top 3 reasons why I don't like index investing, more specifically in the S&P 500. So not everything's bad though. I did talk about diversity, and diversification of your portfolio is something that you generally should aim to do if you can help it. However, what does diversity even do in a stock portfolio? Well, people say it reduces unsystematic risk. However, there are a lot of studies that came out that say that you can get 90% of the benefits of diversification from owning around 10 to 15 stocks. There are a lot of diminishing returns to the gains from diversity, which is a little funny. This is also excluding the fact that if you truly wanted to diversify your whole portfolio, you wouldn't purely invest in stocks or equities. You would invest in stuff like bonds, real estate, maybe even art or crypto. But you never hear anyone say something like, oh, what should I do with my money? And then the most upvoted Reddit comment says, oh, you should invest in total market funds, real estate across the world, some art pieces, all cryptocurrencies. No one says that at all, right? They just say S&P 500, call it a day. And I'm not saying that you should invest in all these other alternative assets or like something like gold or silver. I'm not saying that. I'm just saying that if you truly wanted to diversify, you would do it across different asset classes, not just within one. Turns out people selectively virtue signal about diversity in finance as well. But we found out one important thing. One of the main benefits of investing in an index is that you get something that's nicely diversified, but we could achieve that on our own doing something much simpler and something that we're more intimate with. And before we get into the actual method of birthday investing, I just want to say that there is no one-size-fits-all solution. So that's why I hate when people just regurgitate the same advice over and over. I could imagine there's some future Warren Buffett that's posting on Reddit right now or posting on Twitter, and he's a 20-year-old version of Warren Buffett of our time, and he's probably talking about his whole investment strategy, and I could see like hundreds, thousands of people going into his post or comment saying something like, nope, you're wrong, you shouldn't do that, just invest in an index, you can't beat the market. There are probably a ton of people doing that, and maybe that person, the future Warren Buffett, listens to them and never realizes his full potential. That would be a very, very sad thing. What I'm trying to say though is that everyone has their own preferences, everyone has their own risk tolerances. So because there's no one size fits all solution, you would never hear a doctor recommend the same thing for a 20-year-old as he would an 80-year-old, or people with two different conditions. That just never happens. A doctor gives a different prescription to different people. The same thing goes for investing. So generally, when you are young in life, you want to be taking a little more risk than when you're older. So what ends up happening is if you do index investing, you end up having the same risk profile your entire life, which is a little silly to do. There are such portfolios as like target date portfolios, which kind of solve this through changing your balance in bonds, but some people don't like bonds, and still you could do that method yourself in a pretty easy way. However, let's get into one hypothetical scenario where you are just out of high school or just out of college and you saved everything up in your first year of working. And let's say there's an investment out there that either doubles your income or makes it go to zero. Obviously, this type of investment is only for people with very high risk appetites, but if someone did that and they ended up losing all their money, all they would lose in their life is 1 year of working, which really isn't that much in the grand scheme of things. However, if they ended up doubling their money instead, they would actually gain 7 years worth of investment gains if their gains were similar to the S&P 500, which typically takes around 7 years to double. So as you can see, there's a big disparity in the risk and reward there. However, let's say that you are 60 years old, would you make that same bet? Obviously not, because you would be risking 40 working years of your life instead of just one in order to gain 7 years of investing gains. So it's a very easy illustration showing how risk affects people when they're young versus when they're old. So now that we know all of that, let's get into the actual mechanics of birthday investing. So it's very simple. There are like 5 rules that you need to follow that I kind of created. And the first rule is pretty simple. This goes for like almost any investing portfolio, and that is just to start investing, because time is the most important factor in any investment portfolio. It's not how skillful you are. It's not how skillful of what you pick. Time is something that is just like automatically a plus. If you think of someone like Warren Buffett that we talked about before, he started investing, I think when he was like 11, and he's like 90 some years old now. So he's had like 80 years of compound interest, which is absolutely bonkers if you ask me. So rule number 2 is you want to start your birthday portfolio based on your age and your risk tolerance as well. So the birthday portfolio revolves around stock picking, and we'll get more into how to actually pick those companies in a little bit. But if you are 25 or younger, the system says to pick 1 to 10 stocks to start off your portfolio in the first year. If you're 25 or older, pick 1 to 10 stocks plus your age minus 25. So if you're 30 years old, you want to pick anywhere from like 6 to 15 stocks. And when you are picking these stocks, you want to pick them with the intention of holding them forever. So it's a new take on those buy and hold strategies. Lastly, within the portfolio, after you selected all these stocks, you need to allocate your portfolio based on whichever ones you have preferences in. So for example, if you really like company number 1, put a little more money in that compared to all the other companies that you picked. Rule number 3 is every year you add a new stock into your portfolio, and then keep doing that whenever you die. Just do it every year. So this could either be every turn of the new year, so on January 1st every single year, or on your birthday, or maybe during Thanksgiving, or maybe when Mercury's in retrograde. I don't really care. Just do it sometime once a year approximately, and keep doing that until you die. So why do you want to do this? Well, when you add more companies into your portfolio, it slowly diversifies it out over time. And generally after around like 5 to 10 years, you already reach that 10 to 15 stock threshold that gets you a lot of benefits of diversity. However, I will add one caveat that you need to be involved in different sectors in order to actually get those gains. You can't just pick like 15 tech stocks, for example, because that would not be a diverse portfolio and you wouldn't actually be getting the benefits of diversification. But more into that later, because again, you could still YOLO. It's just based on your risk tolerance, right? Rule number 4 is whenever you get more money, so if you're working and you save up some money from your paycheck, let's say you can save like 5% of your paycheck, 20%, 80%, whatever it is, and you put that money into your portfolio, you could use that new influx of cash to slowly rebalance your portfolio however you wish. So that's one way to avoid selling certain securities and triggering a tax event, but still being able to rebalance your portfolio over time. The last rule of birthday investing is to reevaluate your portfolio as needed. I do something around like every 5 to 10 years. I want to be doing that, but you could do it every year if you have a lot of time on your hands. So if someone does follow all of these rules, if you started investing at the age of 20, by the time you're 65 years old, you'll have around like 50 stocks in your portfolio, and all of these companies were handpicked by you that you know very intimately. With this method, you also have the added bonus of the chance of accelerating your growth in the very beginning. So for me, I was very fortunate. A lot of the companies that I picked early on all did well above average, and because of that, I trimmed some years off of my like money target or like money goal, whatever you want to call it. So I reduced my timeline from like 10 years all the way to 5.5. I'd say maybe my investment gains contributed to maybe like 1.5 or 2 years of it. And then the other 3 years were from like getting promoted at like pretty decent rates. All right, so now you might ask, why did I construct the rules in this way? So first of all, you want to start small and take advantage of that risk-reward asymmetry that we talked about before. And I also want you to add to your portfolio very slowly because I want to deeply know every single company I put in my portfolio that I'm holding forever. So I'm not just gonna look at 1,000 stocks and pick 10 of them and just throw them in there. I'm gonna whittle it all the way down to 1 instead. And when you do this once a year, it gives enough time for the casual investor to kind of have enough time to figure something out and find stuff without devoting too much time to investing. And it gives the advanced investor enough time to really scrutinize every single document they could get their hands on and look at every single piece of data before they lock something in. But how should you pick stocks to fit into your birthday portfolio? Well, I'm going to use what's called the coffee can approach. So when I first started this investing process, I looked out into the next like 10 years, but I realized that was a mistake and I need to look even further than that. So the approach we're gonna use is called the coffee can portfolio. I don't know where this was invented, but I first heard about this concept when I read the book 100 Baggers by Chris Mayer. And this book was based off of a previous book on the same topic by, I believe it was Thomas Phelps. So for all the youngsters who don't know what a coffee can is, so back in the day, even before my time, before my parents' time too, people used to save all their valuables in coffee cans and then bury them somewhere, typically in their backyard. And when they do that, you don't go and access it that often, right? So whatever they have in there, diamonds, jewelry, watches, it just sits there until they actually need it on like a rainy day. So when you're picking stocks, you have to be comfortable enough with the company so that you can just throw away your password to your brokerage account and be comfortable with that and then do a password reset like 50 years from now. That's why I say before, you should pick your companies with the intention of holding them forever. Obviously, you don't need to. Things change, right? And just because you said you would do something before doesn't mean you have to actually follow through with it later. One way to make money when investing is to pick companies that will exist throughout your entire lifetime. Because if a company exists for like 80 years and they're making money every single year, even if it's like a very low percentage, you're gonna be making some money. Maybe not as much money as you would like, but if you pick like 50 companies over your lifetime, odds are the ones that do make money will make up for the losers that don't. I'm also gonna say that it's very difficult to pick stocks and not everyone can predict the future. In fact, like no one can, right? For example, AOL and Blockbuster were both tremendously big companies in my lifetime, at least, that both don't exist anymore. And had you invested in them, you would have lost a lot of money. But obviously I'm cherry picking bad companies there. I could also cherry pick a different bad company, which is IBM. So in the past 60 years, IBM used to be one of the biggest, if not the biggest companies in America. It used to be a leader in almost everything, but then today they're barely even a player. So let's say you did the coffee can approach with IBM, thinking like, oh, it's the biggest company right now, thinking like, oh, it's like 1960 or something like that. It's a very big company right now. It does all these things. It does that thing. It's technology. It does all this new stuff. How could it ever go out of business? Well, if you invested in IBM 60 years ago, you would have been right. They're still in business. However, they've declined tremendously. But even though IBM declined so much, you still 63 times whatever money you put in 60 years ago. Obviously, that's only a 7.15% return. That's less than the S&P 500, but it goes to show that even if you suck at picking companies, you still make money, right? So imagine if you picked anything that was a little bit better. For example, if we picked Coca-Cola, we would have multiplied our money by 1,000 at a 12.35% return, which is definitely much better than the S&P 500. And it's like, you just multiplied your money by 1,000. Like if you have $1,000 and you put it in there, you have $1 million now over 60 years. That's absolutely insane, right? Let's not even get into even better performing companies such as Berkshire Hathaway. You would have almost gotten a 2,000 bagger at a almost 19% return per year. Obviously, Berkshire Hathaway is heavily cherry picked, but there are other companies that perform ridiculously well as well. What I'm trying to say though is you just need to pick a company that's going to exist in our lifetime. So you have to ask yourself, is that going to be Facebook? Is that going to be Google? Is that going to be ExxonMobil? Who really knows, right? But you have to make that decision yourself. Now comes one important part. So remember the whole diversity benefits that we were talking about earlier. Please, 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 for the love of Steve Jobs, try to pick companies that are at least like a little bit in different sectors. I know right now the hot stocks are like all the tech stocks. My portfolio is very tech heavy too. I'm a little leaning into that, but my risk tolerance is pretty high. So I'm not really too bothered by that. But eventually, as you get older and older and older, try to pick companies in different sectors to actually get the benefits of diversification that we were talking about before. Very important part. A lot of people are going to skip that because they have heavy bias towards certain things. So for other people, it might be like consumer products. For some people, it's tech. For some people, it's like only energy companies or only banks. Like you have to at least spread the love a little bit. But it's all based on personal preference, which is what I love about this system, because it fits everyone's personal preference because there's a ton of customization. But now that we've explained all the basics of birthday investing, let's get into some execution of it. So one common question is, how are we going to weigh the portfolio? And the answer to that is any way you want, as you could have guessed already, because the portfolio has like a ton of freedom to it. So let's say when you start out, you pick 1 to 10 stocks. Let's say you settle on 3 because this person has a pretty big risk tolerance and I don't want to list out like 10 numbers for you all. So let's say you have like one stock that's like by far your favorite and then 2 other ones that are like good, but like not as much as your first love, you know? So you could allocate your portfolio like this: 50% in the first stock, 30% in the second, and then 20% in the third. And then once the next year comes around, you find a fourth stock that like, wow, this one, maybe it had like a huge price drop, but the underlying company didn't really change. So other people were overreacting a little bit. Whatever reason you have, let's say in the new year, your fourth stock, you really like it. What you can do in the next year is weight that stock at around 30% and then have everything else at maybe like 35, 20, and 15%. All adding up to 100. And to do that, we need to rebalance our portfolio. There are 2 options. You could either do this right away by selling some stocks and then buying up whatever's missing in order to reach those allocations, or you could reallocate your portfolio over time. So I prefer the over time method because I don't like getting hit with tax events. So what I do is whenever I get a new paycheck in that second year after I pick the fourth stock, I would put money primarily into that fourth stock. So maybe I put 70% of that cash influx into the new holding and then everything else into everything else. And then slowly over time, that company is going to be at its 30% allocation that I wanted in the very beginning. Then let's say in the next year, you're kind of struggling to pick a stock, but you want to add one. And there's one that like barely meets the requirements, but it's not your favorite, you know? What should you do then? So maybe you could break down your new portfolio into something like 35, 30, 15, 10, and 10% for the newcomer and kind of fit it in that way. And then maybe as your taste changed over time, you kind of mess around with the different weights and you finally get into something that you are truly comfortable with. But it all changes over time because prices change. Some companies become undervalued, some companies become overvalued, and all the added flexibility is what I really like about this approach. Lastly, you could do like a manual rebalance every now and then, like let's say every 6 months you rebalance it the hard way, which is just like selling and buying instantly so that you get to your desired weighting. You could do that. I don't really like doing that again because of the tax implications, but everyone's situation's a little bit different and everyone's risk tolerances are a little bit different too. For example, like one year, one of my biggest holdings was Amazon and it like skyrocketed that year. And I did sell a little bit because it was like getting to be way too big of a position in my holdings. So then like, yeah, I just had to rebalance it and that was that. But most of the time nowadays, I just let things fly. I don't really change things that much. So that's pretty much how you actually do the portfolio like throughout the years. Let's get into some sample portfolios, including what I've been using. So I thought it would be fun to set up my portfolio in a way that everyone can see it and everyone can also easily copy it. So to do that, we are going to use a broker called M1 Finance. So M1 Finance is great because they have this feature that is called pies.
It's a wonderful day for pie.
So essentially, I'm going to go to birthdayinvesting.com. That's the website I just set up. You'll see an article on all the rules and stuff if you really want. And it also has like the summary of this video there too. But this has pretty much been my performance over the years. And yeah, I retired around like early 2001, somewhere around there. And yeah, it went up even higher after that. But since then, it's been down a bit. So a little disappointing there, but you know, life happens, right? Things don't always go up forever. But I'll have a link here that links to my portfolio and you can check it out here. Plus, if you do sign up for an account there, you could get $100 if you meet like a couple requirements. And I also get $100 too. So I pretty much set up like a win-win-win scenario. You win because you get to see what's in my portfolio and you could potentially get some money for it. I win because I potentially get some money too. And then M1 Finance wins because they get another client and they make money through the typical broker ways, right? So literally everyone wins though. It's pretty cool. There aren't really many situations where everyone wins, but this is one of them. So that's, yeah, let me be happy for myself, you know? But let's get right into the portfolios because I created 4 different pies that you could kind of look at. I have my own pie that I use. I have one that I made for someone else that I'm close to. And they have a much bigger portfolio than me, but they also have like a lower risk tolerance. I have a starter portfolio for some people who want to meme a little bit. You'll notice the theme a little bit later. And then lastly, I was hesitant on doing this, but I included an ETF portfolio. I have like a pseudo copy of the Dave Ramsey portfolio made with Vanguard ETFs because they have like much lower fees than the ones that Dave Ramsey actually recommends, but I just did it because it actually is like pretty sound in theory, all the stuff he puts in there. But I don't like the funds he chooses because they often have like really high fees, and he's going to say that the fees don't matter that much. But like you look at any research study and like 99% of them say that like fees are like the biggest thing ever. But obviously his clientele is a little bit different than what I want my clientele to be. So that's why I made it that way. Well, let's get right into the portfolio. So I just started it today because it's the new month, so it's a new quarter, and I wanted to wait till the new year, but I got way too excited. So I had to start it this quarter, and then hopefully like all the numbers can be like relatively consistent so that we could compare it easily to other benchmarks in the future. So I scrounged up 40 grand, I threw it into a portfolio, and we're gonna be doing 10K in each portfolio, and we're gonna be keeping up with these every single month. I'll be giving a video update. So if you haven't subscribed already and that's of something of interest to you, we'll go over like what's been happening with all our picks. We'll be going over interesting companies that I'm looking at that month and kind of just going over random investment topics during that time too. I feel like this is a good approach because a lot of people don't actually put their money on the line. They just say something and then let it fly. And yeah, I don't really like that, so I'm gonna try to break the mold at least a little bit. Unfortunately, it's a little down today, but like it's just like 50-50, you know? It's up or it's down. But let's go over my portfolio first, then we'll go over the a little less YOLO portfolio, and then we'll go into like a basic one and then the boomer ETF. So starting with mine, I started mine in 2017, well technically 2016, but my first full year was 2017 of like actually like doing a lot of investing. And in there, I picked my first 5 companies, and there's only 4 of them now because one of them was Twitter. May they rest in peace. I'll leave a card up here if you want to like hear about my Twitter story. It's actually pretty cool if you ask me. But I started off my 5 with Twitter, Amazon, Google, Facebook, and Disney. Very tech heavy, I know. And I purposely did this because I have a pretty high risk tolerance. And based on the reasons I talked about before, when I'm young, I want to YOLO a little bit, because if it all goes to zero, if like all of them go bankrupt, they won't, but like, or I should say they didn't, and they probably won't in the near future. But even if they did, I would only lose 1 year of savings at that time, which is not that big of a deal. But if I gain, then I gain pretty big. And luckily enough, I did. But I'll probably explain all my picks later in future videos. I plan on doing a 1 month update of the portfolio every single month. And through that, I'll go over like how it's doing, go over news of certain companies, and maybe talk about new companies I'm kind of looking at and saying no to, or like putting on like the maybe list for adding in the next year. So I think that could be pretty fun, because there are a ton of companies that I've looked at and like rejected. And some of them have done really well, some of them have done really badly. So I'm like really glad that I kind of avoided some of those riskier ones, because I could have potentially bought a lot of companies that actually went bankrupt. I'm feeling pretty decently comfortable with these. So again, one mistake that I made when I was younger was that I only looked out in the next 10 years. I didn't look out into the next 50 or 100 years. I might have to reevaluate my portfolio sometime in the future, but this is what I started off with. Let's go back a little bit. In 2018, I added in Apple. Apple is like really funny because they keep coming out with like new phones every year, and everyone says like nothing's changed, but they've been doing that for the past like 10 years or something like that. I don't know how long it's been. It's been a while, but like no innovation. People still buy it, whatever. It is what it is. I think their like new processors are really cool too. And like once you're in the ecosystem, you're just there forever, right? 2019, I added in 3 companies: Goldman Sachs, Ulta, and Match.com. So you may have noticed a pattern already. I'm trying to branch out on purpose away from tech, and this was one way I kind of started to do that. Also, full disclosure, this is not my actual portfolio. I use a different broker for that, but I'll probably do like a rundown of all the different brokers and like their pros and cons later on. But I literally just created this account last week and put money into it and bought everything on today, October 2nd, because that's the first day of the month when the market opened. But yeah, I got into other types of companies just to diversify a little bit. Hopefully over time, everything equals out a little bit. And then in 2020, I added in AMD. After that, I added in 2021, Fox Corporation. This one was a little stupid. I kind of regret this one a little bit. I really wanted to get into media companies because I did this whole video on like how valuable being able to influence people is, and like all these news companies, they have like so much influence over people, right? And so my 2 choices, because a lot of media companies are actually owned by much bigger companies. So Fox, they own like a billion different things. It's not just like the news channel, right? It's not just their sports network. It's like pretty much a lot of things, plus like a lot of TV shows, whatever, even though they like split off a little bit. So it's a little bit different now. But essentially a lot of TV channels, a lot of like news outlets, they're owned by much bigger companies that own like a billion different things. So if you wanted to invest in like CNN, for example, you could invest in the company that owns CNN, but CNN's success or like decline doesn't really affect the stock that much. I mean, it does obviously a little bit, but it's just one small part of that huge company. So I identified 2 companies that like were kind of a little more heavily weighted for like what I was looking for, and that was either Fox or the New York Times. And New York Times, I would have liked that company a lot more because they're a lot more influential. And the only issue is that I think a lot of other people think the same thing as me, because the whole like valuation of the New York Times was like a multiple that was much bigger than Fox. And obviously newspaper versus TV channel, it's a lot of different moving parts, right? So it's not an apples to apples comparison, but I really couldn't justify buying the New York Times at that price based on what they give, because like the only way to make money on it is if they like get acquired, you know? They're not like, yeah, newspapers in 2020 and beyond, right? It's kind of a joke. But next company we have up is in 2022. I actually didn't add anything, so you may have noticed you can bend the rules a little bit. 2019, I added 3 companies, and then in 2022, I added no companies. Next up, in 2023, I added in Berkshire Hathaway and Target. So Berkshire Hathaway is like pretty much owning Apple. Like Apple's like a huge part of their portfolio, but you also get like everything else that Berkshire has. So Berkshire has like tons of small companies. They have a lot of like banking and insurance. They own a lot of like random crap that's like Warren Buffett approved. So I feel like that one is okay. I know it kind of goes against what I was saying with the whole like index fund thing, but owning like a well-diversified company that has very good management, I feel like it's more of a bet on the manager, and that actually does make sense because it's someone who I respect a lot. But what I use Berkshire Hathaway for is kind of like a cash holding thing. So if I'm not too sure about what to invest in, I just dump it in Berkshire Hathaway. And then once I find a little bit more confidence in something else, let's say I want to increase my AMD position, then I would sell Berkshire and then buy some AMD. Also, when I did buy Berkshire Hathaway, I sold a lot of my Apple shares because Apple appreciated a ton. And it was like by far my biggest position. I was like, all right, let me cut out some Apple, but still hold a little bit of it through Berkshire Hathaway. But I also get all the other stuff that they have. So that's kind of how I use it. It's kind of like my flex position right now. And then the new ad of the year is going to be Target. Target is struggling a bit right now. I may have been a little too aggressive with this, but I've been eyeing this company for a long time in the past, like maybe 5 years or something like that. It's been on my list, but there are other companies that I just like more. And then after the whole like price drop that they had recently, not recently, this was like a couple months ago, I thought it would be a decent time to go in, but turns out they're still facing a lot of the problems from before, but it's all good. All this is for long term. This isn't for short term. It's like a lifetime portfolio. It's not really something that's done for like the next year or something like that, or even the next day. But that's pretty much my portfolio. It's returned, I think now it's around like 20% per year. It used to be 30. When I retired, it was 30% a year. And everyone was like, holy cow, that's crazy. But like, I grew up in a time where the S&P 500 did nothing but go up its entire life. So pretty much since 2009 to 2022 or 2021, it's been like the biggest bull market probably of our lifetime. So it's really not that ridiculous to get like 30% gains when the S&P was pretty much like, I think like 15 or 20% gains throughout that time. I think people are just like haters. They can't believe that anyone in the world can do better than the average. I'm literally just one random person on the internet. There are plenty of people that have done better than me. Imagine all those people who YOLO'd into Bitcoin. Those people are doing like 1,000 times in like a couple years, right? But obviously there aren't many of them, but they do exist. But I just don't get why people can't fathom something existing. It's actually incredible. But let's go into the next portfolio. This is going to be like the moderate portfolio, I would say. It's built very similarly to mine because I manage this portfolio for someone else. And obviously a lot of the same companies, but the weighting's a lot different. And it includes much fewer tech companies because they wanted something a little more diversified. So biggest holding is JP Morgan. Then we have Apple, Goldman Sachs, Google, AMD, Amazon, Disney, Facebook, Ulta, Dollar General, Dollar Tree, Match.com, and Fox. And in this portfolio, I did not hold Twitter. So Twitter didn't really affect anything from this, but I just wanted to kind of note it there because Twitter was like a pretty risky position, but because they didn't want that risk, I did not include it in that portfolio. Going back a little bit, let's go into kind of like one of the ones that is pretty for fun. I'm going to call it the basic B portfolio for now. You'll see why in a second. But we have Target, we have Ulta, we have Pinterest, Starbucks, Etsy, Facebook, Lululemon, Chipotle, and Netflix. So I might need to change the weightings a bit, but I tried weighting it based on how much a typical consumer might like spend on each of these products, both in terms of time and money, but it might be switched up a little. Maybe Target's a little too high. Maybe Pinterest is a little too high too. Maybe I play around with the weightings a little bit later, but if you wanted to like start from somewhere, maybe this is a decent place to start because yes, you are highly concentrated in something. You're mainly in like consumer products, social media, and like some technology. So it's not like purely all in on one thing, but the demographic is definitely one thing. However, you could slowly build out of this portfolio over time as you add on one company every year. And it could be something that people could kind of start their base from. But I kind of want to track this on my own. So that's why I kind of made the portfolio to track in this little thing so I could actually see the real numbers. Next up we have is the Boomer ETF portfolio. So Dave Ramsey separates his portfolio like this. That's what he says on his like radio show. He says 25% in growth and income, 25% in growth stocks, 25% in aggressive growth, and 25% in international. So on his website, he says that growth and income is something like a large cap or blue chip fund. Growth is sometimes called mid cap or equity funds. Aggressive growth is the wild child. They invest in smaller companies, so I'm assuming that's going to be small cap. And then international is everything that's not US. So I'm assuming you want like a total non-US market fund. He does make the distinction that you don't want to confuse them with global funds because they bundle US and foreign stocks together. So I recreated that using an S&P 500 ETF, a mid cap, a small cap, and a total international excluding the US fund. So these are all approximates, and these are not the funds that he actually recommends. I believe people were researching, I've been looking this up, which funds he actually recommends, and people have been trying to figure out which ones they are, and they found two of them pretty confidently. So one fund that he doesn't directly refer to, but it's heavily implied that it's this fund. But the growth and income one has the ticker AIVSX, and then the growth fund is AGTHX. As for the aggressive growth and international, no one knows for sure. But that's one way to start if you're like really interested in that. But they have like pretty high fees. I'm not really about those fees. And yeah, I just rather not, you know. But if you want to follow his stuff, like nothing against it, you know, it's just not my style. But now that we've gone over all the portfolios, again, you have my link and my code down there if you want to check it out. Let's go over the pros and cons. So pros, you can adjust your risk as you age. 2, you know what's in your portfolio. 3, very simple rules. 4, highly customizable. A lot of people talk about like mass customization. This is kind of like a way to do it. I think this is something that is good for like a lot of different people, but it's also highly customizable. So like definitely fits that meaning. And it's really good at like avoiding tax events. It's also good at like rebalancing slowly over time. And you could also concentrate your portfolio however you want, which is a great added bonus for people who want to add in like just a little more extra time than just like blindly throwing money into some random 3-letter fund that they found on the internet. Lastly, if you like investing and you want to spend more time than other people and want to gain advantages from it, this is one way to do that, or I should say potentially gain advantages from it. What's nice about it, I know investing's not supposed to be fun, but it adds a little more fun to it. It's not as boring as just like pure buy and holding because you're adding a new company every year. And I spend so much time like researching new companies when I want to. Some years I don't. Like 2022, I didn't really spend that much time, so I didn't add a new company. But there's some years where I spend like a ton of time doing it, and I find it really fun and rewarding. There are some cons though. And there are like 3 major cons that I identified. So the first one is you need like half a brain to do it. And I don't mean in terms of like intellect or something like that. I mean in terms of honesty. So you need to be actually honest with yourself with the picks that you have. You have to say to yourself, am I actually going to follow the rules? Am I actually going to pick a company that I think will last throughout my lifetime? You have to be like super duper honest with yourself and also recognize your limits. And that's really hard to do for a lot of people, including myself. Don't be like me. Don't try to be a Dogecoin millionaire just because the price was $69,420 and then you could buy 1 million coins for a little under 70K. Don't do that, okay? Like, please, it's not worth it. Second, you need a lot of discipline. Well, not that much discipline. It's just buy and holding. Like, you just do it and like forget it, you know? And then once a year, you do a little change. I guess like every paycheck you put stuff in, but like literally in terms of like picking out what to buy, it's just once per year. Everything else, it should be automatic feeding into the machine, right? But I guarantee you during some drops, there are going to be some people that just can't handle the drops and they're going to have like the weakest hands ever. They're going to sell. And I'm not saying always hold on for dear life. That's not what I'm saying at all. But for some people out there who have never held a stock to zero, oh yeah, full disclosure, my like birthday portfolio, it's probably like 90 to 99% of my total investable assets or whatever you want to call them. I do have like a fund, which is anywhere from like 1 to 10% of my like investable assets, depending on how well it's doing, you know? Like I do have some like some YOLO funds that are like truly YOLO. But I know a lot of people who have been invested in the stock market, and a lot of my older coworkers from the past, they joined the market around like 2009, 2010, and they literally never experienced a down year in their life before until 2018? I think it was 2018, where during Christmas, there was a huge drop off in December, and they were so scared for their life, and they're pissed off because I believe the return on the index that year was like -4%. And they're like, wow, my Ally savings account was returning like 2% that year. And they're like, I wish I put money in there. And I was just like, are you kidding me right now? Like, you had so much gains in every single other year, and you're mad about one bad year because you're so spoiled. You're like 35 and you never experience a down year in your entire life. Meanwhile, I'm sitting there, I'm like 25 or like 26, I don't remember how old I was, and I was like, down years happen, because I only experienced like 1 or 2 up years before that. So I don't have this bloated vision of like, yeah, stonk only go up, right? I actually had the presence of mind to be like, yeah, sometimes it goes up, sometimes it goes down. And I guarantee you, well, maybe not guarantee, but a lot of people like that person definitely sold off a lot of stuff and lost the bounce back. Like, wow. It's tough to say though. Like, you can't really fault them for it, because again, I've held stocks to zero in my for fun account, and it's not fun when you hold something to zero. Just because something goes down doesn't mean it'll go back up, but it also doesn't mean it'll keep going down. You just have to reevaluate every single time. But if you're thinking about like, wow, America doing good so far, all the big companies in America are getting away with a lot of nonsense. Yeah, they had a little down month, but like, probably gonna recover, you know? It's like, we're not a Japan, you know? Enough of that though. Like, investment analysis is probably one of the most controversial things for no reason. And actually there is a reason. It's like, if you are contrarian, you sound like a complete moron until 5 years later when you're like, nope, I told you so. So there's no point in like explaining your thought process in a lot of cases. I'll try to, I'll take the hits, I guess, but like, there's gonna be a lot of debates about this, and it's gonna be heated comment section based on like different types of analysis that people do, because again, it's so controversial, because you need to be contrarian, and if you are, you're either a moron, and at the time you are a moron because it means most people are disagreeing with you. I shouldn't say moron, like you're lonely or something like that, because everyone obviously disagrees with you, but you can only say you're right after 5 years or like 1 year, whatever time frame, and then like, I'm not going to argue about that point anymore because it'll be reflected in my portfolio. So it's just something you have to be careful about talking about with other people. It's like, you don't make friends when you talk about analyzing investments, unless it's with people who you have like mutual respect with. But the final con of birthday investing is that it requires a little bit more energy than just blindly index investing. When you do index investing, you could literally just set up an auto invest and it just does it automatically for you. And yeah, you could just set it and forget it. If you watch only one finance video in your entire life, do that. But if you watch more than one, I highly recommend doing like a little bit more effort, because there are rewards to be gained, you know? But in summary, I hope this does get you started, and let me know your thoughts below, what you think of this little system that I kind of built up. Did it exist before? I don't really know. I tried looking it up and I didn't really see it. And I like thought about this when I was like bored. And before I started my actual portfolio, I was like, hey, let me try to construct something that kind of solves a lot of these problems that I hate. The most important thing I would say before you go into this is, again, when you do pick companies, have the intention of buying and holding forever. I made the mistake. I only looked out 10 years in advance, and I should be looking longer, because I thought like, oh, I just like repick every 5 years, but it's not a good thing to do. You should try to do like forever. So I'm probably gonna reassess my portfolio, maybe like couple years from now. Maybe some of the companies switch a little bit, because I don't think some of them are going to actually last for like 60 years. Maybe for like 40 or 30, but 60, that's a long time, you know? Let me know if you're thinking about doing this. Let me know if you have been doing something like this already. But I'll have everything on the website, birthdayinvesting.com. I'll be posting a bunch of articles there, and yeah, should be a fun time. And of course, monthly updates. I might do a bonus episode next week to like do one of the monthly videos, but like just on like a off week, just to kind of get it started, because there has been a lot of things that have been happening that I think are really interesting in the markets recently, especially with the companies that I'm involved in. That's going to be it for me today. Hopefully you all enjoyed this, and I'll see you all for the next video every single Monday.